Hello, and welcome to CarbonSmart Conversations, from plans to project finance, lessons for carbon removal developers from 12 and Fervo. My name is Marissa Alarcon, Head of Strategic Partnerships and Events here at FlowCarbon. And a few housekeeping rules before we begin today's conversation. All attendees are automatically muted. Polls will be taken during today's webinar. There will be 2 polls going out in the very beginning of this session. We recommend you participate and join these polls. The more information, the better. To ask questions, please click on the Q&A function at the bottom of your Zoom window. We will facilitate our Q&A at the end of this session. A recording of this webinar will also be shared this week on our YouTube channel. Please feel free to share with your colleagues and your network. And lastly, please follow us on flowcarbon.com, LinkedIn, YouTube, and X for our upcoming events and coverage of the carbon markets. We have an exciting panel today, so meet our panelists. Martin Kessler, CBO of FlowCarbon, Dawn Owens, Head of Development and Commercial Markets at Fervo Energy, Jimmy Chuang, CFO of 12, Madison Freeman, MBA, MS researcher of Stanford Graduate School of Business, and last but not least, our moderator, Caroline Klatt, co-founder and COO of FlowCarbon. I'll be passing this off to Caroline.
Thank you, Marissa. Okay, welcome everybody who's already on, and as people are joining, we're starting promptly here because we have a lot to cover. We are thrilled to have a group of experts and operators with us today to discuss plans to project finance. Before we dive in, I want to let everybody introduce themselves and their background, the projects that they're working on, and then we can get into the specifics. So I'll briefly introduce myself as the moderator. As Marissa said, I'm Caroline Klatt. I'm the co-founder and COO of FlowCarbon. And I'm joined by a fabulous panel, including my colleague, Martin Kessler, who will share more about what FlowCarbon does. So Martin, I'm going to hand this over to you.
Thanks very much, Caroline, and thank you everyone for joining today. My name is Martin Kessler. I'm the Chief Business Officer here at FlowCarbon. At FlowCarbon, we operate as a financial services firm servicing carbon removal developers and other decarbonization projects looking to help influence climate change. And we pride ourselves on the very topic of what we're going to be here talking about today, which is connecting large pockets of institutional capital to the emerging developer community that is scaling solutions and needs this capital to implement its vision. So thank you very much, Caroline.
Thanks, Martin. Madison, your paper actually inspired this whole webinar. So I would love for you to introduce yourself and tell us a little bit about the research you're doing.
Sure. Well, thanks for having me, and thanks for reading the paper. What Caroline is referencing, as I'm at Stanford University right now, where I'm getting my MBA and MS, and I've also been doing research here, writing some case studies on first-of-a-kind climate financings. And so I've been thinking a lot about the ways in which different startups and different solutions are tackling that really big deployment scale-up challenge that a lot of folks are trying to figure out, and doing so in different ways with different partners financially, with different strategies to how to structure their companies, with different sort of ideas in mind for what is really the distinguishing factor about what gets built and what doesn't. And so gotten to do quite a bit of work with that here at Stanford, one of which is a guidebook at the law school for climate startups about how to think about first-of-a-kind financing. And Fervo is one of the companies that I profiled there with their facility in Utah. And then also a case study at the business school featuring 12 and their scale up. Before Stanford, I used to work in the Biden-Harris administration on climate diplomacy around innovation, and worked as a venture investor for several years as well. So thanks for having me. Excited for this conversation.
Yeah. Thanks for joining us. And you mentioned 2 of the projects that were included. So we're lucky to have Jimmy Chuang on the line from 12. Jimmy, would you introduce yourself?
Sure. I'm Jimmy Chuang, CFO of 12. 12 is a carbon transformation company. And so we capture CO2 with water, we break them apart with green electricity, and we recombine element and turn it into low carbon fuel, chemical and materials. Our mission since day one has been turning CO2, used to be a liability, into building blocks of fuel, chemical materials, and that currently is made from fossil. So the more we can turn CO2 into useful product, we can generate more revenue, the project return gets better, and most importantly, the world gets better. And before I joined 12, I spent about 20 years as CFO and the head of capital market in a few leading renewable energy company in North America. Had the opportunity to finance a few first-of-kind projects and has done quite a few first-of-kind financing structure in the solar and the renewable energy industry, have financed over $20 billion or 20 plus gigawatt renewable energy assets. So I'm very excited to be here with you all today.
Thank you for joining us. And last but certainly not least, we have Dawn Owens from Fervo Energy. Dawn, would you introduce yourself?
Yeah, hi everyone. My name's Dawn Owens, as Caroline just said, and I'm really excited to be here today to talk about project finance and share any insights that I have. I currently lead development and commercial markets at Fervo Energy, where I focus on bringing geothermal and specifically innovative geothermal projects to life. So I've been there for the last 4.5 years. And I've had the privilege while there to secure over 500 megawatts of power purchasing agreements, including some groundbreaking deals like our partnership with Google to deliver 24/7 carbon-free energy. So Fervo, we're really pushing the boundaries of what geothermal can do. We're leveraging technology that was traditionally deployed in the oil and gas space to make geothermal more scalable and affordable. And I'm really proud of what we've been able to do on the financing side as well to help push our projects forward. Things like our $100 million bridge loan with Excalibur Rural Capital, which we secured earlier this year to fund both subsurface and surface development. And I'm looking forward to sharing any insights I have. Prior to Fervo, I spent 17 years in traditional IPP development, doing everything from natural gas to large renewable scales development, and a small stint at a community choice aggregator as well in California. So, look, thanks so much for having me.
Thank you for joining us. I have noticed we had many participants join during our intros. So I just want to run through 2 administrative things for all participants. We have poll questions that are currently live. We'll reference them throughout the conversation. So please feel free to take those polls. And we are hoping to have time for Q&A at the end. So if you have Q&A, please pop it in the chat as we go, and we'll take them all at one time at the end. And with that, we will dive in. So thank you all for joining us again. Madison, I would love for you to give us a high-level overview of that paper we referenced, the Guidebook for Early Climate Infrastructure. Can you share why you wrote this paper, and then some of the biggest themes that you were that you took away as you wrote it and conveyed in the paper?
Sure. So, when I started this research, and I will say I feel like the field has changed a lot, even just in the last year. I have started to see, every conference has a much larger set of conversations that are getting more and more detailed about what first of a kind project development really looks like, really concrete examples. But when I started this research last year, I wasn't seeing as much specificity. I felt like there was a big agreed upon sentiment that first of a kind was really hard. And I was hearing investors say that. I was hearing companies say that. I was seeing companies start to build first of a kind projects, but I wasn't hearing as much recognition of what are the actual details in how those companies are getting there. And what does it actually mean to say, first of a kind? That's a really broad bucket that encompasses a lot of different types of companies. And whether you're, selling a commodity material, whether you're selling power, whether you're, selling something that is installed on a customer site and therefore is maybe can be considered a series of first of a kind projects that are all sort of lumped together, that really matters. And so they started doing a series of interviews last year. I think I ended up doing about 70 to 80 different interviews with folks who were investors, who had been engaged in companies, who had been part of first of a kind projects in parallel industries, and ended up finding that I thought it would be helpful, or I'd hoped it would be helpful to kind of distill some of this into publicly accessible report. And so the guidebook that Caroline's mentioned, which is publicly available, goes through some of these examples, and it goes through an example on Fervo, one on Rondo Energy, and via separation. solutions, and one on monolith materials. And in each of those sort of talks about the distinguishing factors. And each of those are very different projects. Fervo is selling clean power. You have monolith materials, which is selling green ammonia and carbon black. You have Rondo, which is creating these sort of heat bricks that are then constructed into a heat battery that can be assembled at a customer site. And so each of those has, their own risks associated and opportunities to de-risk. And so I was trying to kind of use more of a risk framework and de-risking framework in assessing each of those particular cases, as well as some of the takeaways. I think some of the takeaways I had in the paper were pretty general, and things that Don and Jimmy can talk to, things like making key hiring decisions, bringing on people like Don and Jimmy who have a lot of experience in parallel companies and in other, related institutions that they can really bring to bear and help shape the actual project itself, instead of just bringing them in at the end to raise money for an already set project. And some of them were a little bit more specific for each of those examples.
Yeah. Well, that's a good segue into the questions I have for our project developers or our operators, which is to tell me a bit about your background. So Jimmy, you mentioned your background, which was, it spans Wall Street, the solar industry, and now carbon removals. And you're also experienced in project and structured finance. So can you tell us how that experience sets you up well to deliver on capital raising goals in what what Madison just described as being very challenging, first of a kind?
Yeah, that definitely, this great question. I think I was pretty lucky. I found what I love to do early in my life. I joined the solar industry pretty early, around 2006, and there were not too many of us. And I had the opportunity to work with great people and work on a lot of early financing in late 2000, like the first utility scale solar financing we did in Nevada. We were the very first one putting leverage on solar photovoltaic project as well. And my team and I, we did industry first investment grade solar securitization in 2014 as well. I think I've been through this kind of first of kind financing experience and see solar become such a big trillion dollar industry now, just so helpful for me to navigate the financing challenge in here. And nothing really surprised me anymore, because I have seen a lot of kind of similar challenges in my previous life. And I would say that is one of the key reasons I decided to join 12 about 2 years ago, because I want to bring my skill set and relationship over I built over the past 20 years to this new carbon transformation industry, because I want to bridge the gap between kind of leading institutional investors to the first of a kind climate tech infrastructure. And solar is very mature now. You can raise money pretty easily if you know what you do. And then I just think what we do in a carbon removal transformation is just much more impactful in terms of kind of dollar I raise. And that's why I'm really excited to kind of work every day to tackle the new challenges here. In terms of the financing strategy, I would say you don't have kind of one financing strategy fits all company, because all the company are solving different things and trying to achieve different goals. And the company could be a manufacturer, could be a technology developer, could be a project developer, could be making renewable fuel. And using 12 as example, since we are a vertically integrated company, we do technology product development, we do manufacturing, we do project development, we do construction and e-fuel production as well. So almost we need to have different financing strategy to support each business unit essentially. And that's why we have construction financing from fundamental advisor. For project construction, with project equity investment from TPG Rise Climate to fund project development, operation, and we have SMBC Green Loan to build our next generation manufacturing facility. We are closing equipment financing right now. And I would say early on in 2021, we had a Chan Zuckerberg initiative loan it's very catalytic funding to fund our kind of earlier product development. And once you have this kind of financing structure in place, it is like a flywheel, right? It works like magic. You will just keep going as you sign more revenue contract. You can do more project finance. You generate more cash flow. Then you can upsize your financing facility as you scale up your business. Also at the same time, reducing your financing cost. And all the financing structure we are putting in place is all non-recourse, non-dilutive basis. So everything works really well together. And when the company succeeds or has an exit, it is a much better outcome for the shareholder, for the employee, because the most financing we do here is non-recourse, non-dilutive basis.
Martin, I see you nodding. So I'm sure this resonates a lot with the work you're doing now with companies at Flow Carbon and of course previously, but would love to hear your thoughts on this.
No, for sure. And just to add, similar to the some of the other participants, I spent many years in investment banking doing private credit and structured finance. So similar to the comments from Jimmy, it's very exciting and encouraging to see how this ecosystem is going to support the carbon removal developers and decarbonization project developers that are on this call. The first reaction for my nodding is knowing who's dialed into the call today, and hopefully it gives some confidence that when Jimmy and Dawn were working in solar and other areas 10, 15 years ago, it was probably a very similar landscape to where carbon is today, meaning there was a lot of excellent work being done, but those first projects had not yet happened. But it would be, and I'm sure as we go into this conversation deeper, we'll talk a little bit more about that. But the thing I just want to remind the audience of is that many of you have been working for years putting your projects into operation. And what that means is you've been investing equity dollars, you've been proving the workability of your project, whichever pathway is there. And as you get to the point where you start to have LOIs on feedstock, when you start to have, interested offtake, whether it's for carbon credits or commercial products, those are the fundamentals that will bring this entire space of liquidity to bear. And it's really hard. I'm sure the people on this call will relate to the fact as to how hard it is. But what's very gratifying is that there is a very large institutional investor community that is available to spend time to do the work. It's not always the traditional banking sector. There's a huge emergence of private credit and private credit funds that are looking to seek market returns. They're looking to extend leverage, and they're also looking to move quickly. And if that ecosystem can be brought to bear on the universe of developers that are both on this call, I'm just very excited to hear more about how this conversation unfolds over the next 40 minutes and see if we could take some great questions.
Thanks, Martin. Dawn, so you've been at Fervo. When we spoke, you're employee, I believe, number 4, which now at a company that has close to 200 employees. So you were there for the whole financing journey, early stages, equity raising, and then raising institutional capital. Can you talk to us about that journey?
Yeah, all day, all day if you want. So it's been an interesting one, that's for sure. And I'd say that probably the key theme of that journey for us has been optionality, and that extends in every part of our business, including in financing and fundraising. Whether that means always having, a bunch of different projects lined up or having a bunch of different capital sources that we're seeking at the same time. And so, early on, while we were still proving our credibility within the market and helping to educate folks on how what we were doing was different, we relied a lot more on things like grant funding and looked for sources like that to sort of prove capital. We started with initial VC funding where their risk profile was going to be adequately mixed with the stage of our company development. And slowly over time, we've been stepping up in terms of the confidence in the market in us, which means we get to step down in terms of the cost of the money that we need. So in short, I think it's been a really interesting journey, and I'm happy to talk more specifics, but that's kind of what I would say initially about it.
That's great. We asked 2 questions to the audience, and I can prompt one of them right now. The 2 questions are, What is the biggest obstacle to successful project financing in the environment, which we can certainly talk about and is a whole topic. And then how much capital do you need for your first project finance transaction? And so I want to see what the audience says, and then I would love to hear from both of you and from Madison from other projects about how that aligns with what you would have thought. So I'm going to read the first question, which is for those in the audience, how much capital will you need for your first project finance transaction? So the first bucket is $0 to $10 million, then we have $10 million to $25 million, $25 million to $100 million, and $100 million plus. 49% of our participants, which is say $0 to $10 million for your first project finance transaction. Does anyone on this panel have any thoughts on that or find that to be in line with what you've experienced or seen from projects?
For us, that's very low. Utility scale geothermal is extremely capital intensive. So a full scale project for us, that's the very small check size for us. Yeah.
Wouldn't get you all the way there. Not quite.
Yeah, for us, our first project finance company is about $75 million. The first time we closed. Yeah, with 2 lenders and leading lenders combined.
And Jimmy, one question I would have for you is for that first project finance transaction, or Dawn, perhaps maybe in some of your roles before Fervo, the first one is always the hardest. So I'd be really curious to hear from those first transactions, even if from a different industry, what were some of the biggest lessons you took from that in terms of, things that perhaps could have been done differently, things that perhaps went better than expected. Would love to hear a little bit about that.
Go ahead.
I was just like, Jimmy, no one likes to talk about what could have gotten better. No, actually, but we do talk about that quite a bit. Actually, we've got a pretty strong culture of continuous improvement. We do after action item reviews for everything. So, okay, well, so actually I can talk from the Fervo perspective. I can also talk from some early days, things that we did at NRG that were different technologies, but I think they're a little bit less applicable to this first of a kind because one of the biggest challenges when you're launching a new business and a new technology at the same time is that you are building your credibility for both the company as well as your technology at the same time. And so honestly, this is what I would say was one of the hardest and most challenging elements is getting people to have confidence in your company itself, as well as your technology, especially in geothermal's case, when the last time any financiers went to do geothermal, there was sort of a bust and the geothermal assets did not perform as they were anticipated because traditional geothermal was sort of being funded in mass rounds in the early 2000s, and because of the risk profile and not a well-characterized or well-thought-out plan for subsurface and resource development, there was a lot of those projects that never came to fruition. And so we were actually sort of like fighting, and still are fighting, this sort of counter information that that's the last taste that anyone has ever had of geothermal. And what Fervo does is extremely different because we've actually essentially eliminated that risk, that early risk, by making the subsurface more predictable. But the practical result of that is that, for our very first conversations of this, $100 million loan, first conversations we're having is everyone was saying absolutely no way anyone will fund or do a project or bridge loan on subsurface development. It's too risky. 1 in every 4 wells fail. There's no way we're lending against that. We actually have lent against that, and we did that by showing consistently over and over again and helping really walk the financial community and the folks that we worked with through how what used to be an unknown risk was now a controlled risk. And I say controlled risk because I think that that is another key element that we worked with, was to show, you never want to go in and say project has zero risk, because that's just not how reality works. Instead, you want to go and say, look, we've well characterized these, we're well mitigated against these, and this is how we're different. And so I'd say, education, and by building those relationships early before we needed them, was the way that we helped overcome that initially. Um,
I'd love to just hop in
I-
there for a minute because, oh, I'm
Yeah.
sorry, Madison, I didn't want to cut you off.
No, I was just going to say, Don, that I really love Don's characterization of the sort of confidence cost, balance that you're doing there, and that you're bringing down costs when you're increasing confidence. And I think, just to the point, Caroline, of a lot of folks on the line maybe thinking about smaller projects to begin with too. I've seen a lot of smaller projects, or I've talked to a lot of folks who've sort of, they've been in this weird limbo zone where they're sort of between the size of maybe being able to get a much smaller, easier check, but also needing substantial project finance, but being too small to really be almost worth the while of a larger project finance investor, wanting to spend the time or diligence. And I was curious, honestly, Martin, to hear your perspective on that, because it feels to me like there's a lot of value in being able to bring your investor along the way as you grow from maybe an initial smaller project to the larger project, and be able to kind of, by bringing with you, reduce their perception or their understanding of a lot of these risks, a lot of these concerns, and be able to kind of reduce their diligence needs, their costs, transaction costs, as you grow.
Yeah, it's a very good point. And what I would say is, in our space at Flow Carbon, where a lot of the projects we deal with have been equity funded, or maybe a little bit growth equity funded, and are now trying to make that leap into non-recourse financing. What I would say is, we're really mindful about when we actually choose to take projects to the institutional investing community, because you don't want to be too early. And I don't know if there's ever such a thing as too late, but you certainly don't want to be too early, because investors will have some bandwidth, but not infinite bandwidth, to hear the story. And they want to make sure they're applying it correctly. But when Dawn was explaining that transaction, it resonated very much with what we see with carbon removal developers, because you may be working with a proven technology, which is great. It's usually it's usually the toll that you have to cross through in order to get into the conversation with many project finance investors. But because these are more nascent industries, for lack of a better word, the runtime data isn't infinite. There's not 10 years of operational, experience. There may be one, there may be two, it may be a pilot facility that is looking to scale into a commercial grade facility. And so what I would just share is that we've really been heartened in this journey, as we've been speaking with many private credit investors, that there is a community that understand these dynamics and will work with the data that's available. The question that I was going to just ask Dawn was, when you were proving that, it quote unquote worked, like, what does that sample set look like? Does it need to be 1 year? Does it need to be 5 years? Does it need to be 10 years? And, because this is a question that we work out real time with our own customers and potential customers, and would love just to follow up on that one point with you.
It's so funny, because this is a question, I'm laughing because we ask that all the time. And honestly, with our first full scale project that's in Northern Nevada, we're constantly like, is it 12 months? Is it 24 months? Is it 6 months? It's like, but the answer to date has been about 12 months of continuous operating data. So that was where we landed with most folks. But you said something, Martin, that kind of spurred a thought for me when you were saying choosing the right lender can make a really big difference. And this is one of the insights that I would say that I think we're learning is that one of the things that can make or break the transaction is whether or not, in solar, you still just look for like people who had done the transaction before. They understand your technology. When you're working in a new space, you have to find lenders that are either strategically aligned with you, like investors that are strategically aligned with you, or have in adjacent industries where they have adjacent technical knowledge that they can transpose. And I think that a lot of times people will go into financing conversations and maybe without thinking a lot about that right matchup. And then the conversation never goes well because, for example, when we're talking to someone about our subsurface risk, if we have partners like Liberty or others who really understand the oil and gas space and understand the way we think about risk on that subsurface side, if they're in that conversation, it's like half of the job is already done. And not to say you can't get there with others, but to your point, Martin, people's bandwidth is limited to just sort of cycle and understand. So if you can find someone who sort of already has the baseline knowledge of what you were trying to, the story you need them to understand in order to understand and have confidence in your company and your project, it goes a long way.
Yeah, maybe let me try to answer this question a little differently, more kind of traditional project finance way. So project finance been around for a long time, and for some kind of financing, definitely much harder. But the project finance market is very well understood, and the lender investor really looking for two things, right? One is your cash flow certainty, and one is your capex certainty. And so what I mean by that is you need to have investment grade contracted cash flow for fixed term, fixed volume, fixed price. And ideally, you can fix your operating costs as well, like your input of feedstock costs. So you have a certainty on the cash flow. And then on the capex as well, have a reputable EPC to build a project for you. Ideally, stand behind the production guarantee for you for a certain period of time. So you have a certainty on the cash flow, then you can size, the lender can size the cash flow and figure out what's the payback period, how they can make money. And I would say for first of a kind project, let's not get too creative thinking about like a merchant value of voluntary carbon credit as much, because just I think the investor lender really going to focus on investment grade offtake and the certainty to pay back for their investment. And that's very important to them. In terms kind of when to start a conversation, I do think you should talk to them early on, because for new tech will take a while for IC discussion or credit committee. Ideally, you've done work with them before. Like the lender I'm working with, they've done work with me in my previous life. I have never lost any money. So, well, I will try to do $50 million with you now because I haven't lost us any money. And that kind of discussion can be helpful. But at the end of the day is like they typically for non-recourse project finance, they want to come in around NTP, FID or construction ready because they want to know you have a 90% certainty for the project capex. They don't want the number goes up and down too much. So that's certain time. But then you want to spend time to educate them to understand your technology. Sometimes it will take much longer to get through versus doing a solar project finance from my experience. And I think your mention about this, finding a right partner is so important because like for us, like took us a while to figure out TPG Rights Climate to partner with us. We talked to $1 trillion out there because it's really important to have a investor, project equity investor to innovate with you together and allow you to fit other financing structure like a fundamental advisor, the SMBC loan, so they can grow the business together with you, continue to help you to innovate your financing strategy and doesn't block you from the next financing you are trying to accomplish. So taking your time to figure out right financing partner, that's almost as important than getting the money into the door as soon as possible, in my opinion.
Well, that is a question that I have, which is, do you use advisors? Who do you engage with who do you engage with to engage the financial markets? And who do you consider to be the most trusted partners in the industry? And that's really a question for anyone. Madison, I don't know if you've seen advisors or during your research, but certainly Dawn and Jimmy, having worked with them possibly.
Yeah, like Madison, go ahead. I'm sorry, please.
No, go, Jimmy.
Yeah, so I can do this. So I typically don't use an advisor to raise capital for us unless it's kind of pre-IPO equity offering round, IPO, large M&A transaction. But I personally have worked with all the leading investment bank over the past 20 years, and they can be really helpful. And I think the flow carbon will be really helpful too. Like you can use that advice to help you to increase your capacity, driving down the cost, run the process. That's so very, very helpful at the right time to work with them. And at the 12, we announced $645 million cap raise, I think that's a few months ago. And we continue raising more capital without using any advisor. But like I said, at some point we will. And like I think to me is we would like to reward bankers who help us on financing, lending us the balance sheet. So I would say SMBC, the Sumitomo Mitsui Banking Corporation, has been one of the largest bank in the world, has been really helpful to our business. So when we decide to engage anyone, certainly they will play a major role in there, or their affiliate, which is Jefferies, will be really helpful. So we try to tie the advisory work to someone can lend us balance sheet, continue to help us to advance our business forward.
Yeah, and Caroline, I was just thinking on your question, most of, and it also goes back to a point that was made early on around smaller size, which is, a lot of the companies on the call today, they're looking at first facilities, which may be small, 10 million, 15 million, 20, 30 million, but they have huge scaling ambitions. And this is what's of interest to the institutional investor. So just to make that point, I think it's important. And then Caroline, to your question, in terms of what we see at Flow Carbon, at this stage of a developer's journey, the use of advisors can be critically important because of Madison's point earlier, which is there's not necessarily robust staffing to be able to, navigate those complex worlds of first project financing to do that. But then when you get to a scale of a Fervo or a 12, the capital lets you bring a lot of that sophistication in-house, and it should just change the nature of the relationship. The other thing that I think is just a really important point to make around these first project finance transactions is, if structured appropriately, these are not financing structures that exist for life. They can be refinanced. And so as you kind of evolve into your business model, the cost of capital should go down over time. And because that first transaction is so important to the future ambitions of any one company, I too agree, and our experience has shown as we speak to multiple institutional investors, private credit, infrastructure investors, sustainable infrastructure investors, that the ones that take the time to get to know that company will unlock that first position. And it's very hard for small companies to maintain the velocity of those conversations. And so what you wind up developing, and this is what's so exciting about carbon removal and some of the track laid by geothermal, is that there is a nexus of actionable projects with interested investors. And if we as an industry nail that nexus pretty well, we know that institutional financing just grows. The first one is always hard, but then we start to create the blueprint, as some of the participants on this call have contributed in their respective sectors to date.
Yeah, I mean, geothermal, while there's a ton of innovation and exciting, you're making, you're introducing new innovations and new technologies. It's actually been a proven technology globally. So there are billions of dollars in equity and debt invested in companies like Ormat comes to mind, and other great geothermal companies. So there are new innovations, I guess, that Fervo and 12 bring to the space. Well, Fervo in particular.
Yeah. And so like I said, what's been interesting is to sort of connect and educate on the risk profile. Because I think when we talk about project finance, it really is all just about that risk profile of, like, Jimmy's comments educated or referenced this as well, but it's, really connecting folks back down to what is your appetite for risk? When can you come in, and how does that match with what your project that you're developing? How do those two things talk together, and finding that like concentric circles and overlap? So for us, I was actually wondering if Martin had like my notes. I'm like, does he have a camera in here? Because he's saying almost exactly what I was thinking in terms of like, or what I had written down in terms of your question. Because really, like for us, advisors were extremely important. Like when we were just 5 people, right? And we didn't even have a CFO. And now we have a CFO and a structured finance person and we just a project finance counsel and these things. And so as you start to bring more and more of that in-house, you can handle some more of that stuff early on. But again, I will just echo my conversation or echo my comment about finding the right advisor. The advisor who wants to grow with you and can connect you to the right kind of investor is where there's the most value.
I want to we asked a poll question that's sort of related to this from the folks on the line, which is, what do you view as the biggest obstacle to a successful project finance raise for carbon removal companies? And I know many of the people who are answering this question are actually operators who have these companies. So 46% of respondents said nascency of the sector and limited track record, followed by complexity of securing feedstock supply and revenue offtake agreements, which I would like to talk about on this call, limited in-house expertise and skill sets for novel project structures, and we just touched upon, and insufficient risk assessment and management capabilities in financial institutions. Do any of those answers surprise any of you or differ from what you would have, how you would have ranked them perhaps? So nascency being the number one choice, followed by the complexity of securing feedstock supply and revenue offtake agreements.
I don't know that they surprise me. I feel like that that definitely resonates just from the sort of industry survey work that I had done. I mean, I think one of the things that really jumps out is the offtake and supply, and really needing to be able to nail down some of those prices and understand, especially in more commodity markets, how that influences and how that shapes your business model, because it's just really core to any financing. And I do just want to note, the report and work that I did on 12 with TPG's investment. And sorry, it looks like I'm frozen, so I'm just gonna restart my video here really quickly. One of the things that really came up again and again in the conversations with 12 was just how much 12 was really, how much value and stock that they put into the really detailed offtake agreements, the really detailed supply agreements that 12 had already put together. And, TBG was then able to really feel very quite certain in how they were underwriting, their investment into the company. And so I just want to say, I think that the more detailed that can be, and the more extensive that can be, and the more you can sort of work with your, off taker, you work with your customer and work with your suppliers at the same time you're talking to your financing partner about what they sort of need, or what length that they need those contracts to be at. I think it's really vital and important, and it feels like something to me that I've seen unlock, and that 12 has been able to unlock additional financing through.
Yeah. Can you both tell us a tiny bit about the process of your first significant offtake? I'm sure there were smaller ones along the way, but Dawn, you mentioned Google, and I would love for you to share with the audience, how long did that take? What did that take? How did you, keep going when I'm sure it was a very long time horizon?
Yeah, I mean, it definitely was. And I'm happy to share it because I actually think I'm really proud of it. So, I think the foundation of building and getting any offtake is just like financing, in that it's credibility. And it starts with like them believing that your technology is credible and a viable resource to meet their needs and their solution. And it's easiest if you can find a customer or an offtake whose long-term vision matches the same as you. And we identified Google almost 2 years before our first inking of a deal. Among others, quite frankly, I spoke about our optionality, but Fervo, wasn't just looking with Google. We were looking with anyone who had a large power need and wanted to time match, who really saw value in, 24/7 energy. And obviously Google's 24/7 initiative rose very quickly to the top. But we started a very detailed technology education process with their technical team at least a year and a half before we even had any substantive commercial conversations. And it turned out that that was actually one of the things that was able to push us over when we got to certain snags within our commercial discussion, because we were able to come up now, because we had educated them so much on the technology and how things worked, we were able to, when we got to kind of a tricky negotiation point, they understood enough to come together and have like a collaborative solution. And the first project there in Northern Nevada, that first commercial project, is one that is actually quite complicated in terms of the way it's structured. The value streams are, actually utilize some of the existing an existing asset not owned by Fervo, but where Fervo is working with the existing asset owner to have uptake. That existing owner already had a fully contracted asset to the investor-owned utility, and then Google was in the state trying to purchase and do additional power. And so it really took us sitting down and whiteboarding and not giving up to kind of come up with what is that structure where all of those pieces, where A plus B plus C actually results in a viable project that is then now demonstrating that 12 months of data, like we said, and need for project finance. So sometimes it can be a little hard to think about when you're like in the middle of all this, you're like, oh, this is just so much, not worth it to explain to 12 people in one company about how this needs to work. But it turns out that really does matter.
Jimmy, can you talk a bit about the recently announced very significant partnership that you signed with announced with TPG to transform carbon dioxide into jet fuel?
Yeah, definitely. So I think when we think about offtake at the 12, I would say we do three things pretty well. One is we are building the world leading CO2 electrolysis platform. We convert CO2 to useful product. And we have pretty innovative financing strategy. But I think another thing we do well is we really focus on customer and those understand what they need and help them understand our product as well, and the ability to sign long-term financeable offtake contract with them. And like we start signing take-or-pay offtake agreement with our customer, I would say in 2020, 2021. And the first one is the industry first eSAF, e-fuel contract with Alaska Airlines and Microsoft. And this three-way partnership came together initially because Microsoft is our investor, and also they want to work with us on the CO2 emission reduction for their corporate business travel, so for the Scope 3 carbon credit. So Microsoft introduced us to Alaska Airlines, and that's how we get this kind of three-way partnership together where Microsoft's buying Scope 3 and Alaska Airlines buying the jet fuel Scope 1. And later on, because Alaska Airlines really like what we do, and they became our investor later this year in our Series C as well. So that's kind of interesting. Investor first for Microsoft and become our customer, and Alaska Airlines was customer first and become our investor. And then in addition to this partnership, earlier this year, we announced the 14-year offtake agreement with IAG, which is the parent company of British Airways. And this definitely took a while, a few years, I think 2 to 3 years for sure, in the making to sign this world's largest e-fuel offtake agreement and announced to date. And I think sometimes when you do this kind of first of a kind offtake of financing, it just take a lot of time. But we are super excited about this partnership with IAG, which is 14 years and 250 million gallon total take-or-pay, fixed volume, fixed price. And now we are seeing more and more customers talking to us. They are more familiar with us. We're going to announce a lot more contract next year. And also we are signing contract much faster now because just we have more product out there. We're getting more traction with our customer as well. And I would say one thing Madison mentioned earlier is it's not only offtake agreement, they are the same and they are financeable. So when we were working on our offtake with IAG, we were very fortunate to have TPG Rise Climate as our not only just corporate investor, but also long-term project equity investment partner. And it was so important early on have the project finance and offtake discussion in parallel. So we were able to kind of constantly talk to the TPG and keep them posted and vice versa. about IAG contracts. So having a real-time feedback from your financing partner is so valuable to ensure the contract is financeable. And to me, that's really, really important.
Oh, I so echo that. That's really interesting, Jimmy, because honestly, it's something we've been doing as well, which is, yeah, when you have the access, and I think that's why it's so important to build the relationships with those strategic investors early, because then you're able to, yeah, before you even sign the deal, ensure that the deal is financeable.
I was only going to quickly add, Caroline, that although this last back and forth of Q&A is talking about Google and Microsoft and Alaska and multi-year hundreds of millions of dollars, this is the destination for many of the participants on the call today. But the principles apply even on smaller scale transactions. So I would just reiterate, and if anyone else in the panel has a different view, back to exactly the point Jimmy teased out a little bit earlier, it's all about fixed price, fixed volume, high credit quality. If not high credit quality, are there insurance products that could help bolster the creditworthiness of the transaction? You can think creatively. We're not going to have time to get into it on this call, but a lot of the developers in the US can benefit from tax credits, and there's environmental credits out there, which some entities want to have offtakes for, but project finance and merchant risk in new and emerging markets don't go together. And I think I just want to make the point for all of those on the call that the principles apply even on $10 million, $20 million transactions. And there is an investor out there that will invest if the story holds.
Nice. Okay, so we are in our last 10 minutes now. So I will look at the Q&A, but of course, if there's anything any of the panelists still want to contribute or add, feel free to jump in at any point. So we have Q&A. For those of you who are on the line who are adding Q&A, there's a button on the bottom where you can add them. We've got a bunch of great questions here. The first one is this webinar being recorded? And the answer is yes, this webinar has been recorded and we will be distributing it on our YouTube channel. So for those of you who joined a little late, you can hear the very beginning of it. So here's a question for you, Martin. You made a point on project finance from private credit. Isn't the fund life too short? 5 to 7 years for private credit versus a 10 to 20 year tenors for project finance?
Yeah, it's a really good question. And I do think in this area of private credit, it's a very broad, loosely defined term in some ways that people will use differently. A lot of the private credit investors that we work with, I use by a little bit association to mean sustainable infrastructure and infrastructure investors as well. Private credit encompasses all different types of asset classes, including infrastructure. But to the point of the individual who asked that question, for sure, if the 5-year horizon is sort of the targeted horizon for that particular pocket of capital, it's probably too short. But what I would say is, in the event that a lot of the pockets of capital we deal with start to look at things like 7-year maturities or longer, that's where things start to get really, really interesting. And there's lots of technicalities within the project finance space where, as some of the panelists may know, the legal maturities may be very, very long, 15 years or 20 years, but there's a huge expectation and a structuring design such that these actual financings get refinanced out before 7 years. So it's an excellent question. It's almost a failure of the industry to some degree that all these terms are used so loosely, but generally speaking, longer duration pockets of capital serve this opportunity set better.
Great. Jimmy, here's a question for you. Do you see any significant risk in putting a 5% down payment on a project now so that certain tax incentives, including ITC for things like CHP, can be realized while having 4 years to deploy? Would that equipment be seen as legitimate collateral?
Well, so in the solar side of the business, we do this a lot. We put a 5% deposit, qualify for investment tax credit. So that happens all the time. And I don't want to give people advice on how to do the deposit for the tax credit here, but I would say I see this a lot in the financing structure. We have done a lot in my previous life. So we do the 5% deposit, so can qualify for investment tax credit by a certain time. And then, so that's really important as a part of financing strategy. So I definitely think people do that. That's for sure.
Okay, great. And then, let's see. So this is a pretty big question. We'll answer it as quickly as we can. It's for everybody, but geothermal and ESAF tech platforms have very different technology readiness profiles. How did Fervo and 12 need to devise their financing plans differently, given the difference in comfort with fundamental tech? I don't know. We can actually
Yeah,
just
it's a big
generate that
question. I mean, what I will say
Right.
is that the TR, depending on who we're talking to, each person thinks we're at a different TRL level. That's the real answer. The real answer is like, I feel like my theme of the day is matching, 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 which is like we looked for the investors or project financiers who understood and agreed with the TRL level that we thought we were at, so that we could effectively deploy our capital. But definitely it's funny because honestly I could answer it for both sides, because if I'm talking to one set of investors, they think I'm a brand new unproven technology, and if I'm talking to another, they think that geothermal is old hat. And so yeah.
And yeah, and I totally agree. I think have a right investor lender to validate out your technology is so important, right? Like TPG, SMBC, and fundamentals, a big lender investor in the world, and they really validate your technology, your brand, help you raise money much easier in the future for project finance. And then for first of kind tech, just going to be a lot of people say no to you. You just have to keep going. Like in my previous life in the solar business, no one say no to me at all. But here, a lot of people say no to me, and just part of life. And you just have to keep going and find the right partner, understand your technology, want to give you money, and continue with you on the journey.
Yeah, and maybe
Yeah.
one more, sorry, Caroline. I was just going to say one more thing that could be useful is I think we've found the value as well in not underestimating getting ahead and proactive on independent engineering and independent validation, because for newer technologies at times, banks are always going to want an independent engineering report when you get into traditional project finance. But if you have a new technology there, you may need to also educate and bring those engineering and third-party validators along with you. So I think that's a key insight of something that we did right that hopefully could help others.
Yeah, all the
Yeah, I
project
feel
from the IE. So go ahead, Madison, please. Sorry.
No, I was just going to say, I feel like so many of the folks I talked to had done this sort of bringing people along your journey. It's not just you get to a point and then suddenly you go out and you raise project finance and here's the approach to getting that whole project done. It's sort of you're building all of this into the earliest days of the company and sort of stacking all of this, and that creates that really bought in coalition who's going to be with you for that whole path to like then be able to make the project real.
Yeah, you need a part 2 of the paper. Like you need to continue on these journeys.
I am working on a part 2 right now, actually on offtake agreements, and I've been talking to Dawn quite a bit about this, about Fervo's example. So stay tuned. Hopefully that'll be out in February.
We look forward to it. Well, I know we are at time. So if anybody has any last closing remarks, we'll do it now. But I want to thank our panelists again. I think this conversation has been super interesting, super dynamic. We could probably easily fill another hour. So really thank you. We will post this live. So for everybody who's watching and who wants to share it, we will post this on our YouTube channel. And the panels will all have access to it. And you can reach out to any of our panelists via LinkedIn, for those of you asking for contact info. So yeah, thank you everyone for joining us and for taking time on your Monday.
Thanks all. Thanks for having us.
Thank you. Thanks so
Thanks
much.
so
Thanks for organizing.